By way of general introduction also, I want to alert you again to a main theme that we'll be exploring in this morning's series of lectures. And that is black workers' trusts, black employees' trusts, and design considerations that flow from the difficulties associated with debt funding of the acquisition of shares by employees. You need to be aware that 8 out of the 20-odd points on the BEE ownership scorecard are devoted to measuring the extent to which equity shares acquired by black people is free of debt associated with the acquisition of the shares. So if you're going to rely on traditional debt funding approaches, if you're going to lend money to the trust or to the black employees to enable them to acquire shares, you will have a difficulty at the outset. You will have a scoring impediment under the ownership scorecard. Okay? The other difficulty attendant upon traditional debt-financed acquisitions of shares by or on behalf of black people is that if they do borrow money at interest, then there will be no deduction available for tax purposes in respect of interest paid or incurred. They are deriving a stream of dividend income. There may also be fringe benefits tax exposures on loans to employees, unless you charge interest at the official rate. There may be deemed dividend exposures when you make loans to a trust in order to fund an acquisition of shares by the trust, and you again don't impose interest at the official rate. Generally speaking, traditional debt-funded approaches to the establishment of black workers' trusts and the like are to be avoided. They are to be avoided also because of a simple practical consideration. If the only source of income available to the shareholder, out of which debt might be redeemed, bank interest met, is dividend flows from the company, then in all too many cases, the dividend flows will not suffice. And in all too many cases, such schemes which are reliant upon traditional debt funding founder. They founder in particular under pressure from the bank. They founder because of a forced sale of the shares. And you have to begin your whole empowerment story again from scratch. Okay? Now, we will be exploring ways and means, which facilitate an issue of shares to, in particular, black workers' trusts, without the shares being issued at a discount and without reliance upon debt. Okay. Now, the intriguing question is going to be, by what means can we obviate debt funding without issuing shares, again, at a discount to their market value? Okay? And that is going to be the subject matter of the next session. Now, might I just ask at this stage whether you have any questions in relation to the introductory lecture? All familiar terrain, all clear? I'm sure you're all familiar with those fundamental distinctions between restricted and unrestricted equity instruments. Okay. Let's look then at the whole question of workers' trusts and how we obviate reliance on debt funding. When we establish workers' trusts, the first thing we have to have regard to is an annexure called an annex, Annex 100B, to BEE Statement 100. BEE Statement 100 being the BEE statement that deals with the ownership scorecard. Annex 100B prescribes qualification criteria for the recognition of trusts and employee share ownership schemes. By qualification criteria, Annex B means criteria that you must meet, and if you don't meet them, you will have no recognition under the ownership scorecard for the ownership of the shares by black people. Okay? It is a principal requirement under Annex 100B, firstly, that the trustees are to have no discretion in regard to the allocation of distributions. Yeah? So you can't, for example, have the trustees at their discretion paying employees bursaries for tertiary study. Yeah? You can't have the trustees at their discretion pay employees' children's school funds. Yeah? Those are all laudable objectives, but adopt them in your trust deed and it will not be a qualifying trust deed for the purposes of the ownership scorecard. Annex 100B, and there's some intrigue in this, provides that at the latest on winding up or termination of the scheme, quote, all accumulated economic interest, for which read trust capital, retained income, must be transferred to either the beneficiaries of the trust or to a representative entity. What that formulation implies is that you can defer a vesting of the shares pursuant to this trust-based scheme until such time at the latest as the trust is wound up. Okay? Right? Now, if you do so, you will be issuing restricted equity instruments. Okay? All right. Now, there's a certain advantage in deferring a vesting until the trust is wound up, but I will elaborate on that later. I should first elaborate on the role of debt under the BE regime. The scoring of the so-called realization and net value points is governed by escalating targets. The shares are not required to be immediately and entirely free of debt at the time of their issue. What is required is that they should be 10% debt-free as a target in the first year, if you to get your points, 20% in the second year, and so on, escalating through to year 9. It's not a simple comparison of the issue price of the shares and debt. What is measured annually, if you do this properly, is not the issue price of the shares, but the prevailing value of the shares, their market value, at the measurement time. So even without any retirement of debt, you may be assisted in reaching your interim targets because of an increase in the market value of the shares. Okay? I want to suggest certain design rules in relation to the establishment of a black workers' trust. The first is that it is advisable to defer a vesting of shares in the beneficiaries in order to obviate exit payments. Let me explain myself there. If shares vest in the scheme beneficiaries at the outset, then when an employee leaves the employ of the company, there will generally be an obligation to buy that employee's shares back. Yeah? Establish the scheme on such a basis. And what you will have to do in the trust accounts, yeah, is to create a provision, yeah, for the repurchase of shares. Call it a redemption reserve. Yeah? That redemption reserve may impose a very substantial burden on the trust. It may severely impede its capacity to make regular dividend distributions on a year-by-year basis to scheme beneficiaries. Yeah? It may result in the company, through the scheme, principally rewarding not those employees who continue in service, but those employees who leave the company, which is surely not a desirable commercial result. Okay? Particularly if you are instituting the scheme as a spur to productivity. Okay? All right. The second design rule is that one must avoid reliance upon debt funding in order that you might secure the 8 realization come net value points at the outset, that is immediately upon the issue of the shares. Yeah? Now, as to obviating debt funding, I want to share with you an approach which relies on Section 42 of the Income Tax Act. Now, Section 42 is one of the so-called corporate rules. It specifically governs asset for share transactions, where assets are transferred to a company and the form of payment is an issue of shares by that company. Section 42 usefully also covers share for share exchanges, the assets which you transfer to a company against an issue of shares by the company may themselves be shares. Okay? It is by way of share for share exchanges that one can readily, in most cases, impose a holding company, yeah, between an existing company and its existing shareholders. And it is such a share for share exchange which is a first step, yeah, in devaluing the shares in the employer company to such an extent that you can issue shares to the Black Workers Trust for nominal consideration, say R1 per share. But let me illustrate that in detail by way of an example. Let's assume Joe holds all 100 shares on issue in JOCO and that those shares are worth 75 million rand. Yeah? Joe wants to set up a Black Workers Trust. As the first step, Joe will have to acquire a shelf company. Okay? As a second step, Joe and the shelf company are to enter into an agreement of purchase and sale. Under that agreement of purchase and sale, Joe sells all his shares in JOCO to the shelf company. He sells them at market value, and the purchase price is settled by JOCO, by Shelfco issuing shares in itself to Joe. So presto, we now have a holding company interposed between Joe and JOCO. This sets the scene for a further step. The next step, step 3, involves JOCO in declaring a dividend on loan account to Shelfco, its holding company, in an amount fully aligned with the goodwill inclusive net asset value of JOCO. The goodwill inclusive net asset value of JOCO will equate to the value of the shares in JOCO. We are imposing a very substantial debt burden on the balance sheet of JOCO. We are doing so in order that JOCO may, in the wake of this dividend declaration, in the wake of its devaluation, if you like, then issue shares to a black workers' trust for nominal consideration, say £1 a share. Okay? Now, behind this, there is a deal of technical analysis. Yeah? There are, in particular, some intriguing questions arising from the Companies Act, yeah? Looking to the liquidity test, the solvency test, and whether these tests can be satisfied where you declare a dividend, yeah, in an amount which looks also to an off-balance sheet asset, such as goodwill. Yeah? Can you validly do that? Yeah? But before we get to those issues, let's run through the basic tax analysis. The share-for-share exchange will be governed by Section 42. Where Section 42 applies, Joe will be taken to have disposed of his JOCO shares for consideration aligned with their base costs. Yeah? The shares that Joe takes up in Shelfco will inherit the base costs of the transferred JOCO shares. Shelfco's base costs in respect of its newly acquired JOCO shares will coincide with the base cost of the JOCO shares while they were still in the hands of Joe. That's the basic outcome under Section 42. Now, allied to that, there's also relief from securities transfer tax under Section 81A1 of the Securities Transfer Tax Act. Now, that's your tax analysis. But let's turn to the more intriguing questions against the background of the structure we've established with Shelfco now interposed as a holding company between Joe and JOCO, and a dividend of 75 million having been declared on loan account in favor of Shelfco. The object of the transaction is again to devalue JOCO by imposing a substantial liability, a loan account liability, on its balance sheet. And it's this devaluation of JOCO which might then facilitate an issue of shares to a workers' trust for nominal consideration, say R1 per share. Yeah? Aside from the issues arising under the Companies Act, there is a technical issue of an accounting nature. Yeah? You will not truly have succeeded in reducing the net asset value of JOCO to nil unless the face value and the fair value of the loan account liability are aligned with one another. Yeah? If the 75 million were, for example, to be repaid in installments of 7.5 million rand a year, interest-free over 10 years, the fair value would be way below the face value. You will not have reduced the net asset value of JOCO to nil. You will not legitimately be able to issue shares for a mere R1 per share. So the terms of settlement of the loan account have to be such as to align fair value with face value. Yeah? And beyond that technical question, there are then again these Companies Act related questions in relation to the solvency test and the liquidity test. Looking